Hello, everyone. This is Ted Bauman here, editor of the Bauman Daily, of the Bauman Letter, and of Profit Switch. This week, I want to talk about just the activity levels in the market recently. It's something that really struck me. I'm recording this on Thursday, the day before it's released, and the markets opened down dramatically and then bounced back significantly into positive territory by about 1 o'clock, or maybe even a little bit earlier than that when I'm recording this. And it struck me that that's actually something worth talking about, because I think it suggests that we need to think about what signals we pay attention to, what signals we give the most credence to when we make our trading decisions. Because I've seen a lot of people writing into me recently concerned about daily moves, when in fact that's the last thing you should be looking at. And I'm going to explain why I think that's the case. First of all, I've described in a couple of different recent publications and videos my view of the stock market by metaphor is it's like a pack of hunting hounds. Investors are like a pack of hunting hounds that have got themselves into a cul-de-sac, maybe a hedgerow or something, and they lost the scent and they can't figure out what to do next. And so they're milling about, looking to try to pick up the scent. And they will do it. They always do. I mean, hunting hounds and investors always find the next big thing and they pursue it. And where we are right now, though, is in a state where everybody is still milling about, each one like an individual dog trying to find the scent. And that creates a lot of noise, a lot of confusion. And I think it's creating a lot of angst in the market. It certainly is amongst my readers. So I wanted to talk about that today. Before I do, let's just review a couple of charts that show where we are in the market, because we have seen a significant change in the market from last year. Last year, everything went up all the time. We know the reasons why. And this year was supposed to be a different year. It was supposed to be a year where things were going to continue to go up, but different things. We'd see a resurgence of value stocks. People have been saying value stocks will be like momentum stocks. They're the stocks you want to chase instead of. We've seen the move away from tech, but we have not seen, as I'm going to show you, a corresponding move into cyclicals and value stocks as we expected. But first, let's look at a chart that shows roughly what has happened since about November last year. November last year actually turns out to be a pretty important turning point in the market, right about the time of the election. We saw all the indexes, and this is the Dow, the S&P 500, the NASDAQ Composite, as well as the NASDAQ 100, the orange line. And just after the election, we saw a jump in the market, and it increased steadily until the beginning of January. But then we began to see the beginnings of weakness in particularly the high-flying stocks. In fact, that probably emerged in December. If you look at the distance between the orange line, the NASDAQ 100, and the blue line, the NASDAQ Composite, it began to get bigger in December. Both of them recovered somewhat in January and then collapsed in February and have continued very choppy trading. But the key thing is that NASDAQ 100, which is the big tech stocks, the stuff that everybody loved last year, are at the bottom of the pile when it comes to looking at comparisons between different indexes. The Dow is pretty much caught up with where the it's kind of the leader, if you like. The NASDAQ is still technically in the lead, but in terms of the rate of growth, the Dow is probably the one that's at the top. The S&P 500 is also trying to catch back up. So essentially, because you have cross listings or different indexes include the same stocks, what we're seeing is somewhat of a rotation away from the hot tech stocks, particularly the Teslas and things like that, towards more mundane stocks, but it has not been very clear. Now, the next chart shows the relationship between the S&P 500 on its own and then an equal weighted version of the S&P, which is the RSP ETF, which is equal weighted. Now, the key thing here is that the RSP is showing significant gains above the S&P 500, which means that it's the large cap stocks that are suffering. So when that red line is above the blue line, it means that there's more breadth in the market's gains, and that the stocks that were at the that have the most weight in the S&P 500 by market cap are actually dragging down that index. But there are a lot of other stocks that are actually gaining. The question is, which are they? Well, here's a couple of charts that I plucked from, I think it was from CNBC this morning. This shows stocks that are down this week, these by ETFs. So here's a list. Clean energy down 11%, Invesco solar down 11, video gaming down 7, cloud computing 4% down, Arc Innovation, everybody's favorite, down 5, 3D printing down 3. So that's pretty big pullbacks. Considering 20% is considered a major correction. Well, in fact, at the end of a bull market, if you're down 11% in a week, I mean, that's pretty hefty for renewables of all things. Some things we know that we're supposed to be bullish about and have bullish futures. So these things are being pulled down. In most cases, it's probably because investors got ahead of themselves last year. But what about the other kinds of stocks in the in the market? What about cyclicals? Well, here's some reopening stocks, what you might consider cyclicals. ExxonMobil down 8%, American Express down 4%, Avis down 2%, Disney down 3%. So again, this is not clear direction. This is that pack of hunting hounds stuck in the cul-de-sac, looking for some direction, looking to pick up the scent, looking to see where the market's going to go next. And this is where the question of short-term volatility and intraday trading becomes interesting, because I look at it myself. I mean, I spend most of my time looking over my shoulder at market indexes and stock charts and that sort of thing. And it's becoming really difficult. It's like a trampoline, up, down, up, down, up, down. So here's a chart that shows the S&P 500 over the last 5 days. And look down at the bottom at the RSI and the MACD, which are basically indicators of momentum. Now, over the short term, they're not as useful, and typically we use these over the long term, but you can just see that there's a lot of volatility in price movements intraday, during the day. The overall trend has been down since 3-4 days ago, about the 22nd of March. But then again, we've seen just this big intraday jumping up and down, back and forth, which sends very confusing messages to investors, especially if you've got your finger on the trigger of a trade. Now, here's another chart that shows something similar. It's basically a one-year chart of the S&P, which also shows the kinds of volatility that we can expect. This is a daily chart, so it shows that there has been a lot of up and down trading, even during this big boom period, since the depths of the COVID bust back in March 23rd last year, about a year ago. And the key thing here again is to reinforce that trading, I think, has been speeding up. Now, why would that be the case? We know that there are a lot of people in the market now on apps like Robinhood. Other people have piled in. You can trade on Square. You can trade on your Charles Schwab e-app. All of my brokerage accounts, my 401ks, they all have apps I can trade on all day long if I want to. So the question is it the availability of trading that's the thing, or is it the availability of information? I think it's probably the availability of both. In other words, people have the means to trade, but they also have a lot more information than they used to. The question is, are they using that information wisely? Now, some people talk about smart money versus dumb money in the markets. Sentiment Trader, for example, uses indices that show you the relationship between what big institutional money is doing, which it regards as smart, which is ahead of the curve. It anticipates shifts in market direction, versus dumb money, which tends to be retail traders who follow trends rather than get ahead of them. Now, that doesn't, not to say that retail traders are dumb. It just means that traditionally the big guys have access to more information. The fact is that's changing. I mean, for a couple $100 a year, you can sign up to some pretty sophisticated market information services where you can get information about stocks. You can go on Reddit and hear everybody opining about stocks at 1,000,000 miles an hour, all kinds of tweets and all sorts of stuff coming in, information at you. So there's an overload of information. My thesis is that people are struggling to make sense of it, and they may have as much information or getting close to as much information as the big market insiders, but they are not yet clear about how to use that information. Because the key thing is day-to-day, short-term stuff, even 3 or 6 months out, is mainly just noise. The important stuff is what's happening over a trend line, and a trend line you really cannot tell over certainly not over a day, a week, a month. It's very, very difficult to tell. Stocks that pull back by 10, 20, 30, even more percent can bounce back very quickly depending on how the trend changes. And if you trade on the basis of short-term movements, intraday movements, chances are you're going to lose. So let's look at some statistics that show the average holding times of stocks in the US stock market, which I think illustrates and supports my thesis. Here's a chart that shows the average holding period of stocks in years, right, over going back to 1930. Now, for a long time, people would hold stocks going up, close to 7, 8 years, almost a decade. That began to fall in the 70s, but it has fallen precipitously over the last decade or so, last 2 decades, and it kind of reached an all-time low just before the great financial crisis and in 2020. What that tells me is that people were quickly moving in and out of stocks much faster than they used to. Now, the average holding period for shares in June, at the end of 2019 was 8.5 months. In June last year, it was 5.5 months. So you can see that's almost a 50% drop in the average holding period of stocks, which tells me that people are trading in and out of stocks very quickly. And part of my thesis is that it's because people have time on their hands and they've discovered stock trading as a great activity they want to be involved in. But I think it's also because they are overwhelmed by information. They're getting all this stuff, but they don't know how to process it yet. I fall victim to this myself sometimes. I mean, when I'm researching a stock or researching the direction of the market, I think to myself, wow, this is scary. And then I hear something about the same stock. This is not so scary. There's lots of opinions about these things. There are lots of underlying issues. But at the end of the day, the most fundamental ones of all are revenue, earnings, profit, and rate of growth, and how quickly those things are growing relative to your peers. In other words, fundamentals. And fundamentals are something you have to go looking for. They don't come screaming at you through headlines or through confetti falling down on your your Robinhood app. So I want to close today with a quote from a famous English author and bon vivant, Oscar Wilde, who once said, and here's a picture of him, "A cynic is a man who knows the price of everything and the value of nothing." Now, I think that that's what's happening in the market these days. People are trading based on price movements, not on value. I know it sounds like I'm preaching old school stuff, but I think what's happened is exactly what I predicted last year. I predicted that eventually valuation was going to catch up and people were going to realize how important it is. And it's important to the extent that when a stock goes down, if its valuation hasn't changed, if its future prospects haven't changed, do not sell that stock. And a lot of people are doing that, and they are pushing down the price of otherwise worthwhile stocks simply because they are fixated on price and they're trading based on price, and they're using information that they can easily get about price, and they're ignoring the harder to get information about valuation. So my advice is take a step back. On a down day, don't do anything. Stick to the fundamentals. Look for the stocks that have the real growth prospects and invest in those. Don't sell everything just because it has a bad day. That just adds to the depth of the drop, and it makes it more difficult to figure out the wheat from the chaff in the stock market. Anyway, that's enough for me this week. I'll talk to you again next week. Ted Bauman, signing off.